Welcome to Six Figure Starter, your blueprint for early financial domination as a new high earner. In this video, we'll show you exactly how to prioritize liquidity, handle low-interest student debt intelligently, and maximize tax-advantaged growth from day one. We'll also cover how to prepare financially for a move to a higher cost of living city like New York. Let's get started, and then build momentum step by step. Here's our roadmap. First, we'll cover the big picture mindset that will guide every decision. Next, we'll secure your foundation by building the right-sized emergency fund in a high-yield savings account. Then, we'll discuss an optimal debt strategy, controlling low-interest loans without over-prioritizing them. After that, we'll maximize retirement accounts to lock in compounding and tax savings. We'll follow with smart placement of any extra cash for short-term and long-term goals. We'll walk through a practical case study and checklist, test your knowledge with a quick quiz, and close with key takeaways and next steps. Let's begin with the mindset. Before we proceed, a brief disclaimer. This content is for educational purposes only and is not individualized financial, legal, or tax advice. Everyone's situation is different, and tax and contribution limits can change. Please verify current IRS limits and consider consulting a fiduciary financial advisor or tax professional before implementing any strategies discussed. Let's set the operating system for your money decisions. The order of operations is what protects you and accelerates growth. First, liquidity through a strong emergency fund. Second, a smart debt strategy that doesn't overemphasize low-interest loans. Third, maximizing tax-advantaged growth to benefit from compounding and reduce taxable income. And finally, investing toward goals with the right accounts and timelines. With that North Star, we can transition into step one. This mind map shows the complete blueprint. At the center is the six-figure starter framework. The first branch is foundation, a high-yield savings account holding 6 months of projected expenses, roughly $18,000 for $3,000 per month, funded before signing a new lease. The second branch is debt strategy. For a total of $13,500 of student loans with rates between 2.75% and 4.99%, avoid aggressively paying off loans under 4%, and after the emergency fund is ready, prioritize the 4.99% loan while paying minimums on everything else. The third branch is retirement. Immediately start your employer plan, such as a 403(b). Maximize pre-tax contributions up to $24,500 to reduce taxable income, and use the Backdoor Roth IRA if income disqualifies a Direct Roth. The fourth branch is beyond retirement. Keep short-term goals under 5 years in high-yield savings, and invest long-term money in a taxable brokerage using low-cost broad market index ETFs. Avoid complex insurance products as primary investment vehicles. The fifth branch covers risk management, lifestyle control, and automation to make the plan stick. Step 1 is all about securing your base. Before you make any large financial move, especially transitioning to a higher cost of living area like New York City, target 6 months of your projected expenses in cash. If you estimate $3,000 per month, that means roughly $18,000 before you sign a lease. Park this in a high-yield savings account that is currently offering around 4% or more. The goal is maximum safety and liquidity, not chasing investment returns. Automate transfers to reach your target quickly. One way is $1,500 per week for 12 weeks, which gets you to roughly $18,000 in a quarter. Consider creating a separate account labeled emergency only, so you are less tempted to tap it for non-emergencies. Hold off on big lifestyle changes or discretionary purchases until the fund is complete. The pie chart shown is just an example. Create your own expense breakdown that reflects your reality. Now for debt. With $13,500 total and rates ranging from 2.75% to 4.99%, you should avoid aggressively paying off loans below 4%. The expected return from retirement accounts or the safety of liquidity often outweighs the minimal interest savings from speeding up low-rate debt. Once your emergency fund is complete, direct any extra principal payments toward the loan at 4.99% while keeping minimum payments on the rest. Reassess quarterly as rates, income, and goals evolve. This decision flowchart helps keep your actions consistent with the strategy. Here's a side-by-side comparison to clarify trade-offs. Aggressive debt payoff guarantees interest savings but can cost you employer matches, reduce your liquidity, and limit tax deductions, making it more suitable for high-rate debt. typically above 6 to 7%. Investing and maintaining liquidity, on the other hand, can deliver employer match benefits, compounding growth, and lower taxable income through pre-tax contributions, at the cost of tolerating market volatility and requiring consistent discipline. For low-rate loans, the invest and liquidity route is generally superior. With a high income of roughly $128,000 or more, you should immediately start contributing to your employer-sponsored plan, such as a 403(b). Maximize the pre-tax portion up to $24,500 per year as outlined in this plan, which reduces your taxable income today and accelerates compounding. Always capture the employer match if offered. Because higher income may disqualify you from Direct Roth IRA contributions, look into the Backdoor Roth IRA to access that tax-sheltered space. Consider setting your contributions to automatically increase by 1 to 2% annually. And always verify IRS limits each year because they can change. This flowchart lays out the retirement contribution path. First, enroll in your employer plan, such as a 403(b). Next, contribute at least enough to receive the full employer match. Then, increase contributions to the maximum pre-tax amount specified at $24,500 per year. If your income is too high to make Direct Roth IRA contributions, route through a Backdoor Roth. Any surplus after that can flow to a taxable brokerage account invested in diversified, low-cost index funds. Finally, rebalance annually to maintain your target allocation. Beyond retirement accounts, prioritize placement based on time horizons. For goals under 5 years, like a home down payment, keep funds in a high-yield savings account to preserve capital and access. For long-term goals, open a taxable brokerage account and select low-cost, broad-market exchange-traded funds to capture market growth. Avoid using complex insurance products as primary investment vehicles due to their fees and potential risks. Seek specialized advice only if you're considering them for specific needs. Automate contributions and draft a simple investment policy statement. Revisit your allocation annually or following major life changes. This timeline shows what to do and when. Immediately, open a high-yield savings account, automate transfers, and enroll in your employer retirement plan. Over the first 3 months, build your emergency fund to $18,000. Between months 3 and 6, keep making minimum payments on all student loans, and once the emergency fund is complete, direct extra payments to the 4.99% loan. Over months 6 to 12, raise your pre-tax retirement contributions toward the maximum and evaluate the Backdoor Roth IRA. In years 1 to 3, hold short-term goals and savings and start a taxable brokerage for long-term investing. From year 3 onward, rebalance annually, avoid lifestyle creep, and periodically review goals and insurance. This table summarizes the priority order and the associated actions. First, complete the emergency fund in a high-yield savings account, targeting about $18,000. Second, maintain minimum payments on all loans. Third, once the emergency fund is complete, channel extra payments to the 4.99% loan. Fourth, maximize pre-tax contributions to your 403(b). Fifth, use a Backdoor Roth IRA if your income is above the Direct Roth limit. Sixth, hold short-term goals and savings. Seventh, invest long-term money in a taxable brokerage using low-cost index funds. Eighth, conduct annual maintenance, rebalance, review, and automate contribution increases. Let's pressure test the plan with a simple case. Suppose you earn at least $128,000. Before you sign a New York City lease, build an emergency fund of $18,000 in high-yield savings. A fast-track approach would be saving $3,000 per month for 6 months or $1,500 per week for roughly 3 months, depending on your pre-move expenses. While you're building the emergency fund, maintain minimum payments on your loans. After the fund is complete, direct extra payments to the 4.99% loan and keep minimums on the rest. From day 1, contribute enough to your 403(b) to get the full match, and as the emergency fund finishes, ramp up to the maximum pre-tax contribution. Once you've exhausted tax-advantaged space, allocate additional savings either to savings for short-term goals under 5 years or to a taxable brokerage invested in diversified, low-cost ETFs for long-term objectives. This sequence diagram illustrates how each paycheck should flow. First, the pre-tax 403(b) contribution is taken out. The net pay lands in checking. From there, an automatic transfer moves money to the emergency fund in high-yield savings until it reaches $18,000. Pay minimums on student loans and cover living expenses next. After the emergency fund is complete, redirect the extra cash to the 4.99% loan. Once that's under control, surplus funds can flow to a taxable brokerage for long-term ETFs, while separately directing any short-term goal contributions to your savings account. Quiz time. Question: before moving to a higher-cost city with $3,000 per month in projected expenses, what is your best first move? Options: A. Max out payments on all student loans. B. Build an $18,000 emergency fund in a high-yield savings account. C. Open a taxable brokerage and buy ETFs. D. Purchase a complex insurance policy for growth. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Building an $18,000 emergency fund in a high-yield savings account prioritizes liquidity and stability before taking on higher living costs. This foundation reduces risk and supports every step that follows. Second question. With $13,500 in total loans ranging from 2.75% to 4.99%, which approach is correct after your emergency fund is funded? Options: A. Aggressively pay all loans equally. B. Invest nothing until all loans are gone. C. Target the 4.99% loan while paying minimums on the others. D. Stop retirement contributions entirely. You may pause the video now to think about the answer. We will cover the answer next. The correct answer is C. After funding your emergency reserve, direct extra payments to the 4.99% loan while maintaining minimum payments on lower-rate loans. This approach preserves liquidity and lets you continue maximizing higher return opportunities, such as retirement accounts. Here is a concise, markdown formatted cheat sheet. It lists the Fast Start checklist. Open a high-yield savings account and label it Emergency Only. Automate savings to reach $18,000 before signing a lease. Keep minimum payments on loans, then target the 4.99% loan after the emergency fund is ready. Enroll in a 403(b) and contribute at least enough to get the full employer match. Then move toward the maximum of $24,500 per year. Research the Backdoor Roth IRA if your income is too high for direct Roth contributions. And finally, place extra cash in savings for short-term goals and index ETFs. For guardrails remind you to avoid lifestyle creep. Increase contributions annually, review quarterly, rebalance yearly, and seek specialized advice before considering any complex insurance products. These are the essential takeaways. Prioritize liquidity by building 6 months of expenses in a high-yield savings account. Avoid overpaying low-rate loans. After your emergency fund is complete, concentrate extra payments on the loan at 4.99%. Maximize your pre-tax 403(b) contributions to achieve tax savings and compounding growth. If your income disqualifies you from direct Roth contributions, consider the Backdoor Roth IRA. Keep short-term goals in savings and invest long-term funds in low-cost index ETFs. Automate your system, review it regularly, and rebalance annually. Let's summarize. Your operating system runs in this order: liquidity, smart debt handling, tax-advantaged growth, then goal-based investing. Build an $18,000 emergency fund before shouldering higher living costs. Keep low-rate loans at minimum payments. And, once the emergency fund is complete, target the 4.99% loan for extra payments. Maximize your pre-tax 403(b) contributions. And consider the Backdoor Roth IRA if direct Roth contributions are not available to you. Place short-term goals in savings and long-term goals in a taxable brokerage with low-cost index funds. Automate your contributions, review quarterly, and rebalance annually. Thanks for watching. If this blueprint helped you, please like the video, share it with a friend who's also starting strong, and subscribe for more practical, high-impact finance strategies. Tell us your next money milestone in the comments and what you want to master next.